G'day fools, I'm Scott Phillips and welcome to another in our ever popular, yes I say it every week because it's getting ever more popular, series, Motley Fool Stock of the Week, where we bring you one of our Motley Fool buy recommendations straight from us, straight to you, so you can get a little bit of a flavour, a bit of a taste of what the Motley Fool is about, or if you remember already, maybe what some other services are about, and hey, hopefully also some money-making recommendations as we go along. Now, as always, I'm going to give you my usual disclaimer, but preparation. Let's call it preparation at the beginning. First thing, this is a buy recommendation right now as we speak. We're recording this in kind of the second half of August of 2021. If you're watching this months, days, weeks, years later, it may not still be a recommendation, so keep that in mind. Second thing, we reserve the right to change our minds, of course. We are long-term investors, so just make sure you remember that. We're not doing stock forecasts for days or weeks or months or even years. Well, not a year. We're looking at multiple years, preferably 3 to 5 years, maybe even beyond. We're looking for those big long-term winners. And very last thing, as ever, we can't give you personal advice. Whatever we say today on this video and any of our videos on our Motley Fool YouTube site or Motley Fool podcasts, we're doing both right now. I'll tell you about that a bit later. Whatever you hear is general advice only, not personal advice. Right, that's out of the way. Just remember, I'm not saying it's boilerplate. Don't ignore it. It's really important. I just know I do it most weeks, so just bear that in mind. All right. Let's get to one of my longer-term colleagues, Mr. Edward Vesely. G'day, Ed. How are you, mate?
Hey, not too bad, Scott. Hey, good to be here.
Mate, I'm really excited to have you on Stock of the Week for the first time, I think. You have started on a couple other Motley Fool video series, and you've been on the podcast before, but this is our very first doing Stock of the Week together. So, mate, thank you for joining us for this one. I got to say, I said before, I think in a couple other contexts, I know most of the companies on the ASX passably well. We've been doing this for long enough. You just kind of learn about these businesses. You kind of know what they do. I'm partly ashamed to say, but also, it's not unreasonable to say, I don't know Bailador Technologies from Adam. I couldn't honestly pick them out in a lineup. So I am coming into this brand new. Hopefully, like some of our viewers and listeners, I get to ask the questions maybe that they would want to know because I don't know this business at all, mate. But you like it enough to have made it a Motley Fool recommendation, a buy recommendation at that. So let's start at the very, very top. Give me the rub. Give me the understanding. What exactly is Bailador Technology Investments? I think it is. What does it do?
Yep. Very good question. So hopefully after the end of this, Scott, you'll know a bit more about Bailador.
That's right.
I'll call it just Bailador just to keep it simple. But the full name is Bailador Technology Investments, and the ASX code is BTI. Now, what it is in terms of its structure, it's a listed investment company. So what that means is it's a company. It's listed on the stock exchange and it makes investments. So it's pretty much what it says on the tin.
That's pretty straightforward. We like that so far.
It is. Look, it's very similar. A lot of members or people out there watching this might know about Argo Investments or the Australian Foundation Investment Company. So the structure is identical. Yes. However, it is extremely different in the way it does its investing. So the way I look at Bailador is it's probably, you could look at it this way. It's like an ASX listed venture capital fund. So what Bailador does is it focuses on the provision of investment capital to unlisted companies in the main, and it's companies which are in the expansion stage. So that is, they don't necessarily invest in extremely small companies where they might have a fantastic idea, but there's been no proof of the business model. So what Bailador does is it invests in those companies which are slightly past that stage. So the risks are going to be a little bit less. Sure, potentially the returns could be a little bit less as well, but they actually find that the sweet spot for their risk reward is right here at this venture stage. You could look at larger companies which are actually listed on the ASX, but you'd argue that possibly that they've been priced in already. So a lot of the return has been made. So it's a very good way for the average investor to actually invest in something like this and gain access to unlisted companies. So yeah, look, it's a good way for early stage investment, and there's not actually too many ways that I would know a way we could do that quite easily. So what Bailador does, it invests in companies. One of them is listed, but that's because they've taken it to listing, and that's one of their priorities. But it has 8 investments. Its strategy, as I say, is to just help those expansion stage companies grow to a point where Bailador can actually end up monetizing its investment, and it'll do that through a number of ways. What they've done in the past is they've actually just made a sale. So, for example, they had a an investment in the mortgage provider Lendy. And recently that merged with Aussie Home Loans to create a much bigger company. And so they decided to exit that investment and take cash for it, which is fine. They made a good return on that. In other instances, for example, I'll just use real examples, of course. There's a company called Stackler, which has just been bought out by the Finnish e-commerce platform Nosto. And what they've done there, instead of taking cash, Bailador has decided instead to actually retain its investment in Nosto. So when looking at the reasons why they would do that, they simply see that there's a fantastic opportunity in just retaining the shares. So they decided not to take any cash off the table. So there's that. And then I just mentioned briefly that there was actually one company there which is listed. And that's not because they've gone out and bought shares in that. That's the company Straker Translations, and the ASX code there is STG. But what they've done there is they've simply held on to their investment. They've taken it public, or they've helped take Straker Translations public. And they've decided to just hold on to their shares. And look, at some point, Bailador will actually monetize that. They'll eventually take the cash and recycle that cash for other early stage investments down the track. But whilst they're retaining those shares in those listed companies, which become listed, and the unlisted companies, they'll actually, they're doing that because they can obviously see there's more upside in those particular investments. So in a nutshell, as I say, it's a listed investment company, and they like to invest in businesses which are not easily accessible by the average investor. So that's effectively what it does.
Nice, mate. I like it. Look, it's an interesting space because we know, I mean, we all wish we could have invested in Facebook or Uber or some of those businesses when they were really, really, really young, right? But unless you happen to know the right VC or venture capital investment firm, unless you happen to be in the good books, unless you had a decent amount of net wealth to be able to get inside that early stage growth story, as you say, it's a tough thing to invest in as an individual investor. They're not doing the so-called friends and family around. They're not doing the kind of, I've got a good idea. Can I have some cash, please, to start my passion business? They're waiting a little bit longer from the sound of it till those businesses have some runs on the board and where they're providing what I assume is growth capital, the kind of acceleration capital. So, well, we've got this great idea. We think we've proven it out. If we had some more money, we could go faster. We could go further. We could go bigger. It sounds like that's the space that Bailador are playing in. Is that right?
Pretty much, yeah. They want to actually try to maximize what they've put down. Look, a good example is their biggest investment, which is now almost 40% of its net tangible assets. That's a company called SiteMinder. And it's actually worth right now $82.5 million or thereabouts. So it gets valued on a regular basis. But this is exactly the sort of company that Bailador likes to invest in. It's metrics from the likes of a SiteMinder that actually is very appealing to Bailador management. Now, just quickly, what SiteMinder does, just to explain its biggest investment, it's a software as a service platform which helps hotels in various countries. In fact, I think from memory, I looked at the number of countries SiteMinder sells its services into, and it's about 160 in total. So it's actually helping hotels manage their revenue and manage their bookings. Now, you would think, they probably haven't done very well given the pandemic. And it's true that they've actually been impacted somewhat, but you can imagine if you're a hotelier sometime in the last 18 months or so, trying to manage your bookings and trying to just keep inventory moving, because an empty room obviously it's obviously a cost, and they've got to get those rooms rented as much as possible. So the subscription to SiteMinder by hotels in the 160 countries that it operates in around the world has actually been an essential service, and it's something that they very reluctantly would give up. And that's actually why SiteMinder is actually bringing in over $100 million or greater than $100 million in the last 12 months and has 90% or more recurring revenue. So again, it's just like investing in a software as a service company. We'll call it SaaS. The hotel or the customer actually will pay a subscription. They see it as essential. It's actually cheaper on a monthly or yearly basis to pay that subscription, so they keep it going. And it's great for SiteMinder, and hence it's great for Bailador because it actually goes out and retains most of that revenue. Looking forward, there might be some hotels at the edge which actually don't renew or don't continue with their subscription, but it's possible in those cases they're hotels that are going out of business anyway. But for most hotels, they're actually wanting to stay in business, and they're actually going to keep their subscription to SiteMinder. So we like it because SiteMinder is a company that continues to invest in its R&D, and it's actually, by the way, a very real prospect for an IPO listing in the future. So Bailador, no doubt, will be keeping its investment. As I say, it's around 39-40% of its NTA, so it's a big chunk of its total investment. But that's something else you've got to consider too. Bailador, as I say, invests in 8 companies. One of those is 40%. So it's fairly concentrated. The other company is just quickly, there's another one called Instacluster, and I'll just go through the top three here. Instacluster, it's an open source database. It's not too dissimilar to MongoDB in the United States.
Okay.
It's also an IPO candidate, and it accounts for around 1/5 of Bailador's NTA, or net tangible assets. And just recently, it's purchased, what was it, $5.5 million in a company called Instant Scripts. And just when that was announced, I actually did speak to the co-founder, Paul Wilson, about that. And I did question, tell me more about it. And the main thing is, I just wanted to know that Instant Scripts and the investment that they're putting down was properly considered. They did a lot of due diligence, and I wanted to know about the management at Instant Scripts. And I was reassured too that the people running the show there are very, very motivated to grow this business. It's actually a company that's in the digital health space, and Bailador thinks it's got some very good prospects. So that's actually one of its 8. It's actually recycled, as I said, money out of Docs Corp, Lendy, and another company called Viastream. And this is the funny thing, $31 million was realized from successful investments in the last 12 months. That compares to $12 million in the year before that. So there's a huge increase in the amounts of cash that have come through the business. That leads to the situation where Bailador can pay a small dividend. It's actually declared a fully franked 1.4 cent dividend, and that equates to around 1% at the moment. It's not something you're going to rely on for dividends. They will be irregular. It's going to depend on the amount of cash that comes in and whether they realize an investment now or an investment in 12 months and so on. But it's an investment that you could easily buy into. You'd keep it as a diversified part of the portfolio. It will do its own thing. It's very, you could say it's very, the way it operates and the way it performs is going to be very different to perhaps the general market. So for that reason, it's very good for diversification. And yet, despite all that, Bailador's carrying value of its own investments is quite conservative. Now, it comes out with the best way to value a company like this is through its net tangible assets. I've mentioned that a few times, and Bailador will actually say, right, this is what we think is we've had the investments valued, and we see that with the number of shares that are outstanding at the moment, we have a valuation of $1.36 or $1.35 or whatever it might be. The interesting thing is, I'm very attracted to what they're doing here, is because when I look into the documents and the presentations by Bailador, and after speaking to them as well, we see that they're very conservative in the way they value their own investments. So, for example, you could look at, most people would know about WiseTech or Xero or Altium, for example. They've got their own valuations, which are way up to the right. What you'll see is with Bailador is that it's actually, I suppose, valued at a much lower rate. So if Bailador's investments were to be marked up at the same rate, you could see a lot of capital gain here. That's only a possibility, but it's something to consider. But also, too, the fact that they're valuing their investments at a particular point, that's actually a lot lower than the revenue growth that the underlying investee companies are delivering. So it's growing at a certain rate. They don't think it's necessarily valued at the same rate as a Xero or an Altium, but it could be. And so I guess there's some upside there to its net tangible assets. Just in general terms, across the portfolio, look, I love the way this company is investing. The average margin's around the 70% mark. Recurring revenue is around 92%. Even with SiteMinder being impacted in the last 12 months or so, the revenue growth has been around the 14% mark. We expect SiteMinder to actually increase from here. We do think, you have to be optimistic, Scott. There's got to be some sort of opening to the world in general after the pandemic.
Eventually, finally.
Hope so, and especially in Australia. But look, there's going to be anticipated improvement with SiteMinder's performance in the coming year. But by the way, I don't think it was that bad to begin with. So all of those reasons they're all reasons why we like Bailador. And the other aspect to it is the inside ownership. Now, I mentioned Paul Wilson. He's a co-founder, and he comes to the business with some very useful private equity experience. So he knows this segment of the market quite well. There's also David Kirk. Now, he's actually a previous CEO of Fairfax Media and an All Black. So don't hold that against him, by the way. He played for the All Blacks quite a while ago. I think it was back in the 80s. But he's running the show. He's a co-founder along with Paul Wilson. The ownership stake between the two of them is around 9 to 10%. So it's quite a good deal of money on the line, you could say. So I think when you look at the risks involved, but the opportunity at the same time, and you look at the founders who've got their own money on the line, it's actually it's not something that you'd necessarily put all your wealth into, but it's something that you could certainly consider putting aside and putting some money into and just letting it be for a number of years. I think investing for 3 to 5 years, as we say, but preferably longer is actually the way to go, because it's going to take time for a lot of these companies to grow and for those investments to be realised. I mentioned net tangible assets. It does this on a pre-tax basis. So if you just look at the investments as they are today, the shares, or the net tangible assets, I should say, are worth $1.51. Post-tax, that's assuming they sold all of their investments and they had to pay tax. The net investments are around $1.36. Last time I looked, the current price was $1.35. So you're actually paying, you're not paying over the odds for anything like this. It's not undervalued either. It's a fair price to pay. But the reason why you'd invest in Bailador is not because of a discount or any perceived discount between the share price and the NTA. You're doing this because you want to see the NTA grow over time. So that, in a nutshell, Scott, is why we like Bailador Investments.
Love it, mate. A quick break here to just remind you, you can follow us on basically every social platform there is, except TikTok. I'm not going to go on TikTok. I'm not singing, I'm not dancing, but you can get us almost everywhere else. Ed, unfortunately, is not yet on Twitter. I might make that my 2021 goal. So if I get there by the end of the year. But if you are on Twitter or Instagram, you can follow me at TMF Scott P, The Motley Fool at The Motley Fool AU. If you're on Facebook, jump onto facebook.com/The Motley Fool Australia or /Scott Phillips Money. And of course, if you are watching this on YouTube, thank you. I apologize. I got a head for radio and a voice for print, but there you go. If you're watching us on YouTube, thank you. Make sure you check out the Motley Fool Money podcast. This episode does appear both on video and podcast, but there's extra podcast episodes you might be missing out on. I should mention, of course, our brand new podcast called The Good Oil with Scott Phillips, where I interview business leaders, experts, entrepreneurs. Really fun set of conversations. So make sure you check that out. If you're listening to this on podcast, thank you. And do check out The Good Oil, but also make sure you jump onto our YouTube channel. We've got these videos. We've got Stocks in Focus, our favorite investment books. It's been on both of those series. Plenty more video content to come from our team to you for free on YouTube. So look, as I said, wherever you are around the web or in your ears, we're there. Make sure you do subscribe. Ed, let's go to the risks of an investment in Bailador Technologies. 8 companies feels like it's pretty concentrated. 40% in one company feels pretty concentrated. We never say people should have 40% of their portfolios in one stock. Obviously, massive changes potentially in valuations of companies depending on how the market moves. How am I going? What risk should we be thinking about? Am I overdoing some, undoing others, missing some altogether?
Yeah, absolutely. I mentioned, for example, Sideminder, 40% of the total net tangible assets. We have to consider too that not all of the investments at Bailador will necessarily be successful. Now, right now they're actually doing very well, but there was I'll just give you a good example. There's 8 companies, but right now that's today. But a few years ago, I think it was back in 2017, Bailador actually had an investment in a company called iPro Solutions. Now, that was again a cloud-based SaaS platform that was targeted at companies and government enterprises that would help them manage vendor compliance risk. So it's a very specific company and had a very specific niche. And I could understand the attraction for Bailador to invest in something like that. At the time, the investment was worth around 6%, 6.3% of the Bailador portfolio. So itself, it wasn't insignificant at all. But unfortunately, what happened with iPro is that it actually went into voluntary administration, and Bailador lost its investment eventually over the course of a number of months. So they actually had to write that off. They did actually hope, and it was hope, that they would actually get some of this back through the liquidation process, but it just wasn't to be, unfortunately.
You very rarely do. Liquidations are pretty, are they?
Absolutely. Now, look, of course, that's 6%. If something like that happened to SiteMinder, or 40%, or any other company that's worth significantly more, than 6%, 10%, or 20%, it could have a huge impact. And it's certainly going to be, you'd say, have put a brake on shareholder returns. I don't think it necessarily wrecks the business model of Bailador. I think the business model is actually quite good, and I like what they're doing with their strategy. But just every so often, all of us make mistakes with investments, and even the guys at Bailador do the same. It does happen. Sometimes it's out of their control. Sometimes the due diligence, maybe in hindsight, could have been maybe a bit better. But whatever it is, these things are going to happen from time to time. So you've just got to consider that. The other thing that I mentioned too in the original report, and this was in Hidden Gems, is that the commercial information that's shared between Bailador and some of its investee companies, in fact, I'd say all of them, I would have to consider is certainly going to be commercial in confidence. So it does mean that there's certainly dialogue going on between Bailador and the rest of those other companies, but there's no guarantee that Bailador could actually share all of that information with the public shareholders in Bailador. So I think what we have to do is we just have to trust that Bailador management is just going to find that right space. Because on the other hand, it's also a risk for the investee companies as well. They've got certain information they're sharing with Bailador, and they don't necessarily want that to go public. So they're having to balance that. I think they're doing that okay at the moment. And the announcements that we see from Bailador are actually pretty good. And we'd love more information, of course, but we actually understand that they've got some restrictions there in terms of the amount of information that they can provide. And I touched on this briefly too. It's just the structure itself. The structure of the listed investment company. Sometimes you'll see that companies have an NTA or whatever it might be, but the actual share price is trading well above or well below that NTA. And so in situations where it's trading well below net tangible assets, it could be there for quite a while, and it could be quite a frustrating experience that even though the underlying performance of the business is actually growing, for whatever reason, you've got no market love for the shares. So, and that can happen. And I think that's the reason why we have to take a very long-term view with something like Bailador. So they're three of the biggest risks that I'm looking at the moment.
Nice, makes sense, mate. I guess to some degree too. I mean, this is a jockey play, the kind of the jargony term, equity term for businesses where you're betting on the people running the business. The Warren Buffett style approach. Look, maybe the businesses are great, but are you buying the businesses or buying Buffett? That's an open question. Plenty of others like that as well. But to some degree, Bailador's entire business model is wrapped up in the few people who are actually allocating that capital, right? Take those people out, and you've got some VC style investments, and someone's got to manage them, make more, sell them, do something. We're kind of relying on the people walking in and out the door every day, right?
Yeah, absolutely. And for that reason, and I mentioned this before, I think Bailador would actually be suitable to any growth portfolio, but you wouldn't want 10 or 20% necessarily in Bailador as part of a portfolio. If you're going to invest, we always say at the Motley Fool, you've just got to do it sensibly. I think Bailador has some excellent prospects long term, but at the same time, you're not going to put a big chunk of your wealth into it. You're not going to mortgage the house and put all of your money into Bailador, for example, or any stock for that matter. It's nothing against
Good
Bailador.
Advice, mate. Good advice.
There's other companies out there. You wouldn't put everything into Telstra or Commonwealth Bank or any other larger company, but you certainly wouldn't do it with smaller companies as well. I just think the best way to mitigate risk is just to sensibly diversify, understanding here that there's 8 companies within this one investment, but you might have 20 other investments in the portfolio. So that's the way we would do it.
Yeah, exactly. Nice one. Mate, wrap it up for me. Let's do our famed 60-second elevator pitch that takes somewhere between 30 and 90 seconds, generally speaking. So no pressure. But let's wrap it up. Let's take the business itself. Let's take the pros. Let's take the risks and wrap it up. Why should our viewers and listeners consider adding Bailador Technology Investments, or just Bailador, BTI is the code to remind you. Why should they add Bailador to their portfolios, mate?
Okay, I'll try and do this in 30 seconds or so. Okay, first of all, Bailador Technology
Investments. You got 60,
no
hurry, no hurry.
Oh, okay. It's a relatively lower risk. I'm not saying it's low risk, but it's lower risk way of gaining investment to early stage investments that are focused specifically on software as a service and platform companies within those sectors, and they continue to grow strongly. It has the potential to add some useful diversification, as I say, to most portfolios. It's trading at a slight discount to NTA or net tangible assets, and of course, you're employing a very motivated and focused management team that I think are very incentivized to grow shareholder wealth for years to come.
That was a spectacular, mate. You didn't even need the full 60 seconds.
There you go.
I told you he was a smart bloke, guys. Thanks for watching and listening to Ed. Mate, thank you for spending your time helping our listeners and viewers learn a little bit more about Bailador Technology Investments. Ed, of course, does run Motley Fool Dividend Investor and Hidden Gems, among other things. He's a very busy man here at the Motley Fool. This one comes from the Hidden Gems service. These are the sort of businesses they're looking for. They're looking for smaller businesses with a little bit more risk, but hopefully a little bit more return as well, and the smaller end of the spectrum, where sometimes you get some companies that may be underloved, underfollowed, underappreciated, potentially. That's certainly what we're hoping for. And to some degree, Ed, I mean, that's what Bailador themselves are doing, right? So it's a bit of a Russian dolls. It's just kind of turtles all the way down. Ed, mate, thanks again. Thanks for start again.
No
Thank
worries.
you for sharing your expertise with our listeners and viewers. And I hope you've enjoyed hearing from Ed and myself. Until next time, full on.